In light of the recent events in Ukraine and the war's impact on the markets, we can clearly see that these are unsettling times for investors. So joining us now to help us better understand how best to cope with this recent market volatility, Charlie Holt from Edward Jones. Charlie, thanks for joining us.
Thanks for having me, Jill.
So what should investors make of all this volatility?
Well, even before the crisis involving Russia and Ukraine, financial markets were facing headwinds due to higher inflation, the anticipation of rising interest rates, and the continuing effects of the pandemic. But let's put it all in perspective. While the Federal Reserve will probably raise interest rates, rates were at and near historic lows. So these new higher rates may not drastically deter businesses from borrowing to expand their operations. Also, higher interest rates can be good for savers who can earn more on their savings. As for inflation, many economists expect it to cool down in the second half of this year as those supply chain bottlenecks start to clear. Additionally, the pandemic's effects may be fading, though we should all be cautious when it comes to making predictions about COVID.
We've learned that lesson. What about the ongoing Russia-Ukraine situation? How should investors be thinking about this?
Yeah, the Ukraine situation is one more unpredictable event, and one thing that financial markets dislike is uncertainty. Russia is one of the world's largest oil producers, so a conflict that could affect oil prices can have a ripple effect on many market sectors. Until the situation in Ukraine calms down, market volatility may continue. Even in this context of uncertainty, though, investors shouldn't lose sight of other factors that can affect the investment climate. The U.S. economy has been growing at a fast clip, and corporate earnings, which are usually a key driver of stock prices, have also been strong.
What tips would you give to investors trying to cope with this market volatility?
Sure. So first, I would say take a break from checking your statements. You may find yourself constantly checking how your portfolio is doing, but this can lead to stress and cause you to make unwise decisions. If you don't need the money right now, take a break from looking at those investment statements. Second, see if you can wait a certain amount of time before making a significant investment move. Waiting a day, night, or maybe a weekend will help you give those strong emotions time to cool and help you consider whether that decision is in your best interest. Third, I would say take steps to protect your long-term investments. If you don't really need the money right away, you shouldn't have to worry excessively over the short-term movements of financial markets. To avoid tapping into those long-term investments, try to build an emergency fund containing several months' worth of living expenses with the money kept in a low-risk and easily accessible account. 4, get some help. When you're facing the ups and downs of markets, a financial advisor can discuss your concerns and maybe illustrate some scenarios that can result if you make certain moves, thereby helping you make better informed decisions. We're living in challenging days, but instead of agonizing over the things that we can't control, concentrate on those that you can, such as making investment choices appropriate for your needs and capable of helping you meet your goals.
Charlie Holt from Edward Jones. As always, great advice. Thank you so much with strategies to help you cope with the market volatility. Thank you.